This question is from James A. Starr. I have read an enormous amount about past market declines and the opportunities they presented to investors. The last 2 years have seemed to me, a 43-year-old investor, a real opportunity. Yet in the thick of the action, I was too scared because I felt the market decline, while severe, was not necessarily sufficient to match the risks of global financial meltdown. So my question is, given that we are possibly not totally out of the woods, how did the two of you assess this latest buying opportunity against the previous opportunities of your life?
You can hear it in the question. Even in the depths of the 2008 financial crisis, the dips didn't look low enough to the person asking. It reminds me of what Morgan Housel says. When you imagine a market crash, you only picture stock prices being cut in half. You forget the context that comes with it. In 2008, people were on TV saying capitalism had failed. In 2020, they said that the world was ending. That fear is the variable you can't simulate in a spreadsheet. Now, let's listen to Buffett's answer.
It's not the greatest one. We've seen a few that scream at us, and we've seen a few periods of overvaluation that scream at us. And 90% of the time, we're somewhere in between, and we don't know exactly where we are in between. The business of being scared, I don't know what you do about that. If you're of that, if you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. And people really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared. And to expect somebody else to tell you when to buy and therefore get your courage back up or something. I could get this fellow's courage up substantially by saying it's a wonderful time to buy. And then a week from now, he'd run into somebody else that tells him the world is coming to an end. And he'd sell. I mean, he's a broker's friend, but he's not going to make a lot of money. Charlie?
Yeah, I think I developed more courage after I learned I could handle hardship. So maybe you should get your feet wet with a little more failure.
Well, I've certainly followed that advice. Some people really do not have apparently they don't have the temperament or emotional stability or whatever it may be to invest in securities. They'd be much better off if there were no quotations at all. And Keynes talked about that some in the past too. To take something that should be an asset, a quotation every day, terrific liquidity. Nobody says how liquid is my farm or something of the sort. So they're not expecting that prices to tell them something about how they're doing. The market is saying this or that. Whenever anybody says the market is saying this or that, it's sort of unbelievable. But there's a lot of interest in investing, and people are going to yak about it all the time. And in the end, what counts is buying a good business at a decent price, and then forgetting about it for a long, long, long time. And some people can do it, and some people can't. Number 9.
Buffett's whole point is simple. If you outsource your courage to headlines, you are done. If your brain is wired so that you get scared exactly when everyone else is scared, you are not going to compound wealth in stocks. That's why his farm analogy is so powerful. A farmer doesn't check a screen every day to decide whether a corn is a good idea or not. He asks, one question: will this asset produce over time? Investing is supposed to be closer to owning a farm than playing a video game. And if you look at what they actually did in 2008, it matches the philosophy perfectly. Buffett did not wait for a clear signal that the crisis was over. In the middle of the panic, Berkshire invested $5 billion into Goldman Sachs through preferred shares, basically injecting capital when the world was questioning whether the financial system would survive. Just imagine the independent thinking and the mental strength it takes to buy Goldman in 2008. That is the real edge. Not genius, not secret information, just temperament, liquidity, and the ability to act when other people cannot. Now, Charlie Munger's line is the real life lesson. He basically says courage comes from learning you can handle hardship. Get your feet wet, fail a bit, build scar tissue. That applies to investing, to business, to relationships, to everything. If you never train that muscle, you will freeze exactly when life offers you the biggest opportunities. I also think you combine that with another mental model. The best way to get what you want is to deserve what you want. Improve your skill set, build reputation, do the work when no one is watching. When you stack that with Munger's Lollapalooza idea, the outcomes multiply. It's not 1 + 1 = 2. The combination gives you 3, 4, or even 5. Now, going back to the markets, let's make it concrete. You can buy a great business like Meta after it drops 50%. In fact, I did that. But it can still drop another 50%. Now the stock is down 75% from the highs, and you are down 50%, even though you bought the dip. As long as the thesis is intact, that is not a signal to panic. It is a signal to lean in. And that is the moment most people fail, because they want social permission to buy. They want comfort. So what I believe is this: if you are not a person who is willing to do the contrarian bets and go against the market, if you are not the type of person to declare that emperor has no clothes, you are likely going to be getting mediocre results. Now, there is nothing wrong with that, but at that point, I believe indexing may be the right call for you. That's it for today's video. I will see you in the next one. Bye.